I'm going to let you know a secret if you promise not to tell anybody. There's really only 3 ways to build up your financial assets in order to retire. And the first one is to win the lottery. So if that hasn't happened to you yet, be sure to stick around in the video. And I'm going to share with you, I think there's a third way, and I'll share that at the end. And the first 2 ways are traditional ways, right? You can either build up assets or you can build up cash flows. So let's talk about, the first one, the building up assets, is what most of us think about when we think about saving for retirement and getting ready for retirement. It's kind of the tried and true way. Frankly, it's the easier of the two to execute and to implement, is building up the assets, right? You spend less than you earn, and both plans depend on this. You spend less than you earn, and then you have to invest it. Again, both plans. But when you invest in cash flow properties and cash flow investments, most of those require a lot more legwork than building a stock and bond portfolio. So the first path, which is kind of the tried and true and what humans have been doing for decades now, I can't say hundreds of years, because in my father's time, very few people actually had investments in the stock market. It's really been, I'm going to be 59 here real soon. And people keep asking me, Azul, when do you turn 59? You keep saying that. Early July. So it's not here yet as I record this, but it's really been in our generation that the average person has used a portfolio of stocks and bonds, right? I mean, in the previous generation, a lot of companies did the investing on behalf of their employees, and some people, the fortunate ones, had pensions, right? They exchanged 20, 30, 40 years of their life, and the company behind the scenes was doing the pension. And you can see that while it's easier to execute and implement, to do it well is not easy, right? Which is why a lot of companies don't offer pensions anymore, is they didn't do as well as they had hoped. They didn't do as well as they had planned, for a lot of reasons outside of the scope of this. So, route number 1 is to build your assets, to spend less than you earn, to save that. Not enough to save it, you also have to invest it, and let compounding work for you. Now, compounding goes both ways, right? If you're beating inflation, compounding's your friend. Over time, that's going to accelerate, and soon, it feels like it takes forever, but if you start saving in your mid-20s, by the time you get to 40, your money starts working pretty hard for you. Your previous investments are working hard for you. So compounding works in your favor, but if you try to hide from what you think is risk, which is daily volatility, right? The stock market is a bumpy ride. If you try to hide from that volatility and put your money just in the bank and get less than inflation, guess what? Compounding's working against you. So again, it's not enough just to save. I think you need to invest. You need to invest in a way that you're comfortable with, so you don't blow out of your investments when there's a scary period in the economy, when there's a scary period in the stock market. Okay, so that's kind of tried and true method number 1. Remember, I'm going to give you this third one, and I promise it's not about winning the lottery. By the way, some people have asked me about my goofy hat. If you stick to the end, I'll tell you the story of my goofy hat as well. It's a fun story. Okay, so the second method is really the Robert Kiyosaki. He kind of brought it to the masses, the idea of amassing these different sources of income streams. And income streams, for most of us, are really going to be like rental properties. It's going to be real estate, or as we get older, we have experience in the industry, maybe we can buy a cash flow generating company, right? You don't have to be a billionaire to buy companies. I mean, you do have to be a billionaire probably to buy Starbucks, but if you wanted to buy all the stores, obviously. But to buy a small or medium-sized business near you, that's probably in the realm of a lot of people that are in their 40s, 50s, maybe even early 60s. It is a pretty stressful job. You got to ask yourself, if you're going to be in your early 60s soon, Do you want that stress? Do you want that stress in your 40s or 50s as well, right? Okay, I'm going to turn around here. So it's amassing these cash flows. Again, a lot of us are familiar with rental properties. Maybe we buy a duplex or we buy a single family dwelling and we rent it out. You know, obviously real estate has had a big jump. This is not my area of expertise. I'm just sharing high level. You know, this is how people have done it. And Robert Kiyosaki, the author of Rich Dad, Poor Dad, kind of made the idea famous and brought it to the masses. Clearly, you know, people have been buying rental properties for a long, long time. Robert Kiyosaki didn't invent that. But one thing you have to be careful is when you invest in the stock market, very seldom are you using debt. And I would argue this isn't financial advice. I don't know your situation. I encourage you to work with a fee-only financial advisor. That said, you know, I would advise you not to use debt when you invest in the stock market. But it's very common to use debt when you buy a rental property, or if you were to buy a company, a small to mid-sized company, you're going to use debt. And debt can get scary very quickly, right? You've worked your whole life to amass this your savings, and you don't want to put yourself in a situation where you jeopardize your financial independence. So, you know, that's one reason that a lot of people shy away from cash flow investing properties, is usually the cost is higher, and in order to make the numbers work out, you need debt. And just like I said, compounding is a double-edged sword. It can work for you, it can work against you. It's the same thing with real estate. Right now, most of us, you know, it's like 80% of Americans my age own houses, and the vast majority of those people have a mortgage, right? So we're all familiar with that, or the vast majority of us are familiar with that. And there are riskier ways to use debt, and then there's less risky ways to use debt. But you can get yourself in a bad situation quickly if you get too aggressive. So what is Azul's hybrid model? My hybrid model is, you know, what if we're building up these assets, right? So we're in our younger years, we're doing that which is a little bit easier. You know, when you're younger, you probably don't have as much experience. You're going to be less likely to be able to successfully run a company if you were able to buy it. You're less likely to have that company succeed under your leadership just because you don't have the experience yet. You will in time. So that avenue is probably best done in your mid-30s and above. Not for everybody, but for a lot of us. But, you know, rental properties, could you buy a duplex and live in one side of the duplex and rent out the other? You probably could, right? For a lot of people, that would be a match. So in your early 20s, your mid-20s, your early 30s, you're building up your asset base and you're investing it in the stock market. Then maybe you take some of that money and you have real estate. So that builds up both of those avenues. And so it's not either or, but it's a hybrid. Again, not financial advice. I don't know your situation. I have worked with clients that have done it. The ones that tend to succeed are the ones that are super conservative on their debt. They're not over leveraging things, because, you know, things that aren't supposed to happen have a way of happening all the time. So be careful. All right, speaking of being careful, people have said, hey, Azul, why do you wear that goofy hat? Well, during the pandemic, I was fortunate enough to be up in the Scandinavian countries. And this is a hat that is used by the workers in a fishing factory. So the boats come in at the end of the day with all the fish and the workers. This is the type of hat that a lot of the workers would use. And I was able to buy one. So it reminds me of lots of fond memories of being up in Scandinavia. And I also, frankly, you know, I know it looks a little bit goofy. And so it just shows my independence and my comfort in my skin. I know it looks goofy, but I feel good when I wear it, so I wear it. I hope you enjoy it as well. And I hope you enjoy these two videos. This one up here that talks about average income for retirees in the United States. And this one down here that talks about 5 reasons to retire as soon as you can. Thanks for watching. Bye-bye.